I need you to stop whatever you're doing right now and listen very carefully to what I'm about to tell you. Because what I'm going to share in the next 30 minutes will fundamentally change how you understand the silver market, the banking system, and the existential crisis that is unfolding right now beneath the surface of financial markets. This isn't speculation. This isn't theory. This is mathematics. Cold, hard, undeniable mathematics. And the numbers are screaming that we are approaching a catastrophic failure point in the precious metals market that will trigger the largest banking crisis since 2008, possibly larger. Right now, as I'm recording this on January 13th, 2026, silver is trading at $8,642 per ounce. To most people watching financial television tonight, that's just a number. It's a metal going up. It's a percentage gain on a chart. But if you understand what's happening in the derivative markets, if you understand the position of the primary dealers who are supposed to be the backbone of market liquidity, you realize that $86 isn't just a price level. It's a tripwire. It's the beginning of a liquidation cascade that could bring down institutions that were considered too big to fail, institutions that the entire global financial system depends on to function. Today, I'm going to walk you through the exact positions held by JP Morgan, HSBC, and Scotia Bank. I'm going to show you the mathematical certainty of their insolvency if silver reaches $100. I'm going to show you the emergency measures the Federal Reserve is already implementing behind closed doors to prevent a systemic collapse. And most importantly, I'm going to show you why the window to protect yourself from what's coming is measured in weeks, not months. Because when this breaks, when the primary dealers start declaring force majeure or requesting emergency bailouts, the financial landscape will change overnight. And the people who are prepared will preserve their wealth. The people who aren't will watch helplessly as the system confiscates their deposits to save itself. Let me start with the positions, because understanding the size and scope of what we're dealing with is absolutely critical. According to the most recent data from the Office of the Comptroller of the Currency, the OCC quarterly derivatives report released in December 2025, the top 4 U.S. banks hold 93% of all precious metal derivatives in the American banking system. 93%? That's not diversified risk. That's not distributed exposure. That's concentration that would make any risk manager lose sleep. And the real exposure, the real danger, is concentrated even further in just 3 institutions that are primary dealers in the silver market: JP Morgan Chase, HSBC, and Scotia Bank. These 3 banks collectively hold short positions representing $46 billion in notional value of silver derivatives as of the end of December 2025. Now, let me explain what that means in practical terms, because this is where the danger becomes clear. A short position means they have sold contracts promising to deliver silver at a specific price. They make money when the price goes down because they can buy the silver cheaper than they sold it for and pocket the difference. They lose money when the price goes up because they have to buy expensive silver to fulfill contracts they sold cheap. And right now, with silver at $86 and climbing aggressively, they are losing catastrophic amounts of money every single day, every single hour. Every tick higher on the chart is billions of dollars in additional losses. Let me break down the math so you can see exactly how bad the situation is. When these short positions were established over the past several years, the weighted average entry price was approximately $54 per ounce. Some positions are older and were entered at $40 or even lower. Some are newer positions at $70, but when you weight it by the size of each position and the timing, the average across all their short positions is approximately $54 per ounce. With silver now at $86, they are underwater by $32 per ounce on their average position. $32 per ounce on $46 billion in notional exposure. Now here's how you calculate the actual loss and why this becomes an existential threat. The notional value of $46 billion at an average short price of $54 represents approximately 851 million ounces of silver. 46 billion divided by 54 equals 851 million ounces. At a $32 per ounce loss from current prices, that's $27.2 billion in mark-to-market losses. $27.2 billion. Let me repeat that. $27 billion in losses. That's not a number you can hide in a quarterly earnings report. That's not a rounding error. That's not something you can smooth over with accounting tricks. That's an existential threat to the solvency of these institutions. But it gets significantly worse, because silver isn't stopping at $86. The technical breakout we witnessed 3 days ago, the arbitrage spread with Shanghai that continues to widen, the physical shortage that's causing 8-week delivery delays at major mints, all of this points to silver heading toward $100 in the very near term, possibly within the next 2 to 3 weeks. And at $100, the mathematics become absolutely catastrophic for these banks. At $100 per ounce, the loss per ounce increases to $46. 100 minus 54 equals $46 per ounce loss. Multiply that by 851 million ounces, and you get $39.1 billion in losses. Just under $40 billion. Now let me put that number in context, because this is where you need to understand why this threatens the entire banking system. JP Morgan Chase has Tier 1 capital, the highest quality capital that can absorb losses, of approximately $200 billion. HSBC has approximately $130 billion in Tier 1 capital. Scotia Bank has approximately $50 billion. Combined, these three banks have roughly $380 billion in Tier 1 capital. A $40 billion loss represents 10.5% of their combined Tier 1 capital. That might not sound like a complete wipeout, but here's what you need to understand. Bank regulations require that Tier 1 capital ratios stay above certain thresholds. For globally systemically important banks, which all three of these are, the minimum Tier 1 capital ratio is 8%. But regulators start getting very nervous and imposing restrictions when that ratio drops below 10%. A $40 billion loss doesn't just hurt these banks. It pushes them into the danger zone, where regulators have to step in, where restrictions get imposed, where emergency measures become necessary. But we're not stopping at $100. Let me show you what happens at $150, because that's where this becomes a civilization-level crisis. At $150 per ounce, the loss per ounce becomes 96. 150 minus 54 equals $96 per ounce loss. Multiply that by 851 million ounces, and you get $81.7 billion in losses. $81 billion. That's 21% of their combined Tier 1 capital. That level of loss doesn't just push them into the danger zone. That level of loss makes them technically insolvent. That level of loss requires emergency intervention by central banks and governments to prevent a complete systemic collapse. Now, you might be thinking, okay, but they can just close their positions, right? They can buy back the contracts and stop the bleeding. And yes, in a normal market, that's exactly what they would do, but this isn't a normal market. This is a market where physical metal is disappearing, where premiums on physical silver are running 9 to 12% over spot, where delivery times have stretched to 8 weeks. If these three banks tried to close even 10% of their positions, if they tried to buy back 85 million ounces of silver, the buying pressure would send the price absolutely vertical. It would trigger the very crisis they're trying to avoid. They would be buying into a rising market, pushing the price higher with every purchase, increasing their losses on the remaining positions. It's a trap, a mathematical trap with no easy exit. This is why I keep saying that the primary dealers are fighting for survival right now. This isn't about protecting profits anymore. This is about preventing insolvency. This is about preventing a collapse that would make Lehman Brothers look like a practice run. And here's the truly terrifying part. The Federal Reserve knows this. The U.S. Treasury knows this. The Bank for International Settlements knows this. They have all run the stress tests. They have all seen the numbers. And they are already taking emergency measures behind closed doors to prevent this from becoming public knowledge until they can execute a controlled solution. Let me show you the evidence that this emergency response is already underway. On January 6th, 2026, just 1 week ago, the Federal Reserve announced an expansion of its standing repo facility. They increased the maximum amount that primary dealers can borrow overnight from $80 billion to $150 billion. The official explanation was routine liquidity management. But that's not routine. That's a $70 billion increase in emergency lending capacity. That's the Fed preparing to inject massive amounts of liquidity into the banking system to prevent a derivatives crisis from becoming a banking crisis. On January 8th, the Federal Reserve Bank of New York held an emergency closed-door meeting with the primary dealers. This wasn't on the public schedule. This wasn't announced in advance. We only know about it because of a regulatory filing that had to be submitted after the fact. The official description of the meeting was discussion of market operations and liquidity conditions. That's Fed speak for, we need to figure out how to prevent you from collapsing. 3 days later, on January 11th, JP Morgan transferred $42 billion from its broker-dealer subsidiary to its commercial bank subsidiary. That's an internal transfer of capital to shore up the entity that would face losses from derivative positions. That's not normal operations. That's emergency capital reallocation. And then yesterday, January 12th, HSBC issued $2 billion in subordinated debt. Subordinated debt is expensive capital. It pays higher interest rates. Banks only issue it when they need to boost their capital ratios quickly. The fact that HSBC is issuing subordinated debt right now at premium interest rates tells you they are scrambling to build a capital buffer against losses they know are coming. This is silent recapitalization. This is emergency preparation happening in real time, while the financial media talks about healthy market corrections and normal volatility. Now let me explain what happens if silver reaches $150 before this recapitalization is complete, because this is the scenario that keeps central bankers awake at night. If silver hits $150 in the next 60 days, before the primary dealers can build sufficient capital buffers, they face three options. None of them are good. All of them are destructive. And all of them end with ordinary depositors and investors paying the price. Option one is a bail-in. Let me explain what that means, because most people don't understand this term until it's too late. A bail-in is when a failing bank recapitalizes itself by converting the liabilities it owes to creditors into equity. In plain English, that means they take your deposits and convert them into shares of the failing bank. Your cash disappears. Your savings account becomes stock in a company that's collapsing. This isn't theoretical. This isn't conspiracy theory. This is official policy that was implemented after 2008 to prevent taxpayer bailouts. The Dodd-Frank Act in the United States and similar legislation in Europe specifically allows for bail-ins of depositor funds above the insured limits. In the United States, the FDIC only insures deposits up to $250,000 per account. If you have more than that in a single bank, the excess is not protected. It can be bailed in. It can be converted to equity. And here's the part that should terrify anyone with significant deposits. During the Cyprus banking crisis in 2013, they didn't just bail in the uninsured deposits. They took 47% of all deposits above $100,000. People woke up one Monday morning and discovered that half their savings had been converted into shares of failed banks. The shares were worthless. The money was gone. If JP Morgan, HSBC, or Scotia Bank faced insolvency from silver derivative losses, the same mechanism would be triggered. Deposits above $250,000 would be at risk. And given the size of the losses we're discussing, $81 billion, the haircut could be massive. It could be 50%. It could be 70%. Wealthy individuals, small businesses, anyone with significant operational cash in these banks would see their balances slashed overnight. And here's the cruel irony. The people who would be bailed in are not the people who caused the crisis. They're not the derivative traders. They're not the executives who built these massive short positions. They're ordinary depositors who thought their money was safe in a major bank. Option two is a COMEX force majeure declaration. Let me explain what this means and why it's equally catastrophic. Force majeure is a legal clause that allows a party to void a contract due to extraordinary circumstances beyond their control, wars, natural disasters, acts of God. In the context of COMEX silver futures, it would mean the exchange declaring that, due to unprecedented market conditions, they cannot facilitate physical delivery of silver. All contracts would be cash settled at a price determined by the exchange, not at market price, not at the prevailing physical price. At whatever price the exchange decides is fair. Here's why this is devastating. If you're holding a silver futures contract that you intended to take delivery on, expecting to receive physical metal worth $150 per ounce, and COMEX declares force majeure and cash settles you at $90 per ounce, you just lost $60 per ounce. You lost 40% of your expected value, and you have no recourse. It's in the contract terms that you agreed to when you opened the position. COMEX has the legal right to do this, and if the primary dealers cannot fulfill delivery obligations because they don't have the physical metal and cannot acquire it without bankrupting themselves, force majeure becomes not just an option, but a necessity. The consequences of a COMEX force majeure declaration would be profound and lasting. It would destroy confidence in the paper silver market permanently. It would prove that the futures contracts are not backed by real metal. It would validate every conspiracy theory about price suppression and market manipulation, and it would cause an immediate and total decoupling of paper prices from physical prices. Physical silver would trade at a massive premium to the worthless paper contracts. Anyone holding ETFs that settle in cash, anyone holding futures, anyone with paper exposure would be wiped out. Only holders of physical metal would preserve their wealth. Option 3 is direct Federal Reserve intervention through unlimited quantitative easing. This is the most likely outcome because it's the path of least resistance politically. The Fed cannot allow major banks to fail. The Fed cannot allow COMEX to declare force majeure. So they will do what they always do. They will print money. They will create dollars out of thin air and use them to recapitalize the failing banks. They will buy the bad derivative positions onto the Fed's balance sheet. They will socialize the losses and stick taxpayers with the bill. But here's the problem. The Fed's balance sheet is already at $8.9 trillion. It peaked at $9 trillion during the pandemic and has only declined slightly. If they need to inject another $80 to $100 billion to save the primary dealers from silver derivative losses, that pushes the balance sheet back toward $9 trillion. And that money doesn't disappear. It enters the economy. It increases the money supply. It causes inflation. And not just a little inflation. We're talking about gasoline hitting $7 per gallon. Groceries up another 20%, rent increasing 30%. The currency debasement required to save these banks from their silver bets would destroy the purchasing power of every dollar-denominated savings account in America. So let me lay out the timeline of how this unfolds, because understanding the sequence of events helps you position yourself correctly. We are currently in phase 1, silent recapitalization. The banks are quietly raising capital, transferring funds, expanding credit lines, and building buffers. The Fed is expanding its lending facilities. Regulators are having closed-door meetings. This phase lasts as long as silver stays below $100, and they have time to build defenses. We have maybe 3 to 4 weeks left in this phase. Phase 2 begins when silver crosses $100. At that point, the losses become too large to hide in quarterly reports. Analysts will start asking questions. Shareholders will demand explanations. The media will start covering the story. Volatility will increase dramatically as the banks try to defend the $100 level through massive paper selling, through algorithmic suppression, through every tool they have. But if physical demand remains strong, if Shanghai keeps buying, if industrial users keep panicking, the defense will fail. Phase 2 is the battle for $100. It could last days or weeks, depending on the intensity of buying pressure. Phase 3 is capitulation and crisis. This happens when silver breaks above $120 and heads toward $150. At this point, the banks realize they cannot win. The losses are too large. The physical shortage is too severe. They stop defending and start preparing for emergency measures. This is when you see credit rating downgrades, when you see debt issuance at distressed levels, when you see executive departures, when you see emergency board meetings. Phase 3 is chaos. It's when the financial media finally admits there's a crisis. It's when politicians start making angry speeches. It's when you see congressional hearings scheduled. Phase 3 ends with intervention. Phase 4 is resolution through one of the 3 options I described: bail-in, force majeure, or Fed bailout, or some combination of all 3. By the time we reach Phase 4, the decisions have already been made in smoke-filled rooms. The public announcement is just theater. Your money has already been taken or devalued. Your positions have already been closed or converted. Phase 4 is when you find out whether you positioned yourself correctly during phases 1 and 2. So what do? How do you protect yourself from this? Let me give you the strategic framework, because this is not a time for passive hope. This is a time for active defense. First, if you have deposits above $250,000 in JP Morgan, HSBC, or Scotia Bank, move them immediately. I'm not saying move them next month. I'm saying move them this week. Spread them across multiple banks. Keep no single institution exposure above the FDIC insured limit. Yes, it's inconvenient. Yes, it's a hassle to manage multiple accounts. But convenience is not worth the risk of losing half your money in a bail-in. The warning signs are already visible. The emergency measures are already underway. By the time this becomes public knowledge, it will be too late to move your money. Banks can freeze large withdrawals during a crisis. They can impose capital controls. They can limit daily withdrawal amounts. Move your money while you still can. Second, if you have any exposure to silver, through paper products, through ETFs like SLV, through futures contracts, through unallocated bank accounts, you need to understand your counterparty risk. Read the fine print. Most of these products have force majeure clauses. They have cash settlement options. They have provisions that allow the institution to give you dollars instead of metal if there's a market disruption. And a COMEX force majeure declaration is exactly that kind of market disruption. If you want exposure to silver, hold physical metal or hold PSLV, which has transparent allocated storage and a redemption mechanism. Do not trust promises. Do not trust contracts that can be voided. Trust only what you can hold or what is verifiably allocated in your name. Third, diversify out of the banking system entirely for a portion of your wealth. This is not about abandoning banks completely. This is about reducing concentration risk. If you have significant wealth, consider holding a portion of it outside the traditional banking system. Physical precious metals in a private vault or home safe, real estate that you own free and clear, productive land, businesses that generate cash flow, assets that cannot be bailed in, assets that cannot be frozen by capital controls, assets that maintain value regardless of what happens to bank balance sheets. The purpose of diversification is not to maximize returns. The purpose is to survive extreme events, and we are heading into an extreme event. Fourth, prepare for currency debasement regardless of which option they choose. Whether it's bail-in, force majeure, or Fed bailout, all 3 outcomes lead to the same place: loss of purchasing power and destruction of dollar-denominated savings. If they bail in deposits, confidence in the banking system collapses and people flee to hard assets. If they declare force majeure, confidence in dollar-denominated contracts collapses and people flee to hard assets. If the Fed prints $80 billion to bail them out, the money supply increases and the value of each dollar decreases. All roads lead to inflation. All roads lead to debasement. Position yourself in assets that benefit from currency destruction. Real assets, productive assets, assets with intrinsic value. Fifth, understand that this is not just about silver. This is about the fragility of a highly leveraged financial system built on derivatives and fractional reserves. Silver is just the trigger. Silver is just the match that lights the fuse. But once the fuse is lit, once confidence begins to crack, the crisis spreads. It spreads to other commodity derivatives. It spreads to interest rate swaps. It spreads to credit default swaps. The entire $200 trillion derivatives market is interconnected. A failure in one corner can cascade through the system. This is why the Fed is so terrified. This is why they're taking emergency measures now. They know that a silver derivative crisis could become a systemic crisis very quickly. Let me give you some historical context, because this has happened before and it will happen again. In 1998, Long-Term Capital Management, a hedge fund run by Nobel Prize-winning economists, collapsed because of derivative positions in Russian debt and interest rate spreads. They had $14 billion in capital and $1 trillion in derivative exposure, sub 71 to 1 leverage. When their positions moved against them, they faced bankruptcy. And because they were counterparties to every major bank on Wall Street, their bankruptcy would have triggered a cascade of failures throughout the financial system. The Federal Reserve had to organize a private sector bailout. 14 banks contributed $3.6 billion to keep LTCM alive long enough to unwind their positions. The crisis was contained, but it was a very close call. In 2008, Lehman Brothers collapsed because of derivative exposure to mortgage-backed securities. They had $25 billion in capital and $600 billion in debt and derivatives. When the housing market collapsed, their positions became toxic. No one would trade with them. Counterparties demanded more collateral. They couldn't meet the margin calls. They filed for bankruptcy, and that bankruptcy froze the global credit markets. Banks stopped lending to each other because no one knew who else was exposed to Lehman's toxic positions. The commercial paper market froze. Money market funds broke the buck. The entire financial system came within hours of complete collapse. The Fed had to inject trillions of dollars in emergency liquidity. The government had to bail out AIG, Citibank, Bank of America, and dozens of other institutions. And even with all that intervention, the economy still collapsed into the worst recession since the Great Depression. Now imagine that scenario, but with 3 major banks simultaneously facing insolvency from silver derivative losses. Imagine the panic. Imagine the contagion. Imagine the emergency measures required to contain it. That's what we're potentially facing in the next 60 to 90 days if silver continues its march toward $150. And based on the technical setup, based on the physical shortage, based on the arbitrage spread with Shanghai, there is no reason to believe silver is going to stop at $100. The momentum is too strong, the fundamentals are too tight, the fear of missing out is too powerful. I want to address the people who think the banks will just manipulate the price back down, who think they'll engineer another smash like they've done so many times before, who think this is just another bull trap that will end with silver back at $70. That strategy worked when the banks had unlimited physical metal to deliver against short positions. That strategy worked when China was a price taker and would accept whatever price the West set. That strategy worked when there were no export controls, and arbitrage kept global prices aligned. None of those conditions exist anymore. The COMEX registered vaults are at historic lows. China has implemented export licensing that traps metal inside their borders. Shanghai is setting the price, and New York is following. The old playbook doesn't work anymore. The game has changed. Every attempt to smash the price now just creates buying opportunities for physical buyers. Every artificial dip gets absorbed immediately by industrial users who are desperate for metal. Every paper dump gets overwhelmed by physical demand. The banks are fighting the tide. They're trying to hold back the ocean with a broom. It's not going to work. And every day they try. Every day they defend these price levels. They dig themselves deeper into insolvency. The losses compound. The positions grow larger. The hole gets deeper. This is why I say the window to act is measured in weeks. By the time this becomes obvious to everyone, by the time it's on the front page of the Wall Street Journal, by the time your financial advisor is calling you with concerns, it will be too late. The bail-ins will have happened. The force majeure will have been declared. The Fed will have announced emergency measures. Your deposits will be frozen or converted. Your paper silver positions will be cash settled at unfavorable prices. Your wealth will have been confiscated or devalued to save the system. The time to act is now, while you still have options, while you still have control, while the crisis is still hidden beneath the surface. I'm not telling you this to scare you. I'm telling you this because you deserve to know the truth. You deserve to understand the risks. You deserve to have the information necessary to make informed decisions about protecting your wealth. The mainstream financial media will not tell you this. They are dependent on advertising revenue from these same banks. They have relationships with these institutions. They don't want to cause panic. They don't want to be responsible for triggering a bank run. So they downplay the risks. They call it normal volatility. They say the system is sound. They tell you not to worry. But behind the scenes, the emergency measures are already underway. The recapitalization is already happening. The crisis is already here. It's just not evenly distributed yet. The mathematics are clear. At $100, these banks face $40 billion in losses. At $150, $81 billion in losses. Those numbers are not sustainable. Those numbers force intervention. An intervention means someone pays. Either depositors pay through bail-ins, or paper silver holders pay through force majeure, or taxpayers pay through Fed bailouts. One way or another, wealth is going to be transferred from the public to save these institutions from their derivative bets. The only question is whether you're going to be on the paying side or whether you're going to be positioned in assets that are protected from the carnage. The crisis is coming. The timeline is compressed. The window is closing. Move your deposits. Convert paper exposure to physical. Diversify out of the banking system. Prepare for currency debasement. Do it now. Do it this week. Because next month might be too late. The primary dealers are approaching insolvency. The Fed is preparing emergency measures. And the price of silver is going higher whether they like it or not. Position yourself accordingly. The mathematics don't lie. And the mathematics say this ends very badly for anyone who isn't prepared.